1/3 of the S&P 500 set to report earnings this week. We want to bring in Gabriela Santos, who is global market strategist at JPMorgan Asset Management. Gabriela, you say that the economy is weaker than it seems from the numbers most people are looking at.
I do think now that we're in this world where we've unwound the zero interest rate policy, the liquidity flush environment we had for 15 years, there's actually a lot of dispersion happening beneath the surface. And that's true when it comes to the economy, earnings, between sectors and between asset classes and regions. When we look at the economy, on Thursday we'll get first quarter GDP. We do expect it to look really, really strong, over 2.5%. We'll see some weakness in the first areas that were impacted by higher rates, manufacturing, housing. We'll see some resilience within services and consumption for now, but we do think the rolling impact of higher rates should be felt in the quarters ahead, and specifically through a weakening in the jobs market, which ultimately impacts consumption and services. So really kind of a high watermark for the economy at the moment.
Which means what for the markets?
So I think it's interesting that the discussion for the markets is the opposite, right? That the first quarter earnings season might mark a low for earnings. And to us, that doesn't quite make sense if we're describing an environment where the economy itself is at its peak strength in the first quarter, and we see some deceleration and perhaps even contraction ahead. So I think that's a bit why so far we've only had 20% of companies reporting on earnings, but we've had some pretty muted reaction to earnings beats, because I think there's some uncertainty about whether that consensus really makes sense or whether we're a bit too optimistic about earnings ahead, specifically at the top line, as you see some weakening in the economy, but also margins. What kind of margins make sense as we're seeing some normalization in pricing ability of companies?
So when we hear from companies that say that they expect to make up most of the numbers, or if they've had a miss for these quarters, they expect to make it up in the second half of the year, you don't necessarily buy what they're selling?
I think it very much depends on the company, the subsector, and the sector itself. But in general, we would be skeptical of that message. And I think especially if you look ahead at the second half of the year, there's still a lot of strength embedded in those earnings estimates, an expectation that you'll go back to positive earnings growth in the third quarter and double-digit earnings growth in the fourth quarter and in 2024. We're not expecting any kind of crisis in terms of earnings contraction. It's just speaking to some downside here in the U.S. And I think the dispersion is upside expected around the world. And here, speaking of Europe and emerging Asia as well, where we see upside to those earnings estimates.
I mean, I've just been thinking through companies we heard from last week. You had AT&T and American Express saying that they expected to see better profitability in the second half of the year, better return to cash flow. You had a company like Procter & Gamble, which really knocked things out of the park, but they did that with the help of 10% price increases that went through. Will they be able to continue price increases? How do you break it down? How do you figure out what you like and what you don't?
I think that's the issue we're having with some of those earnings estimates. Part of it is uncertainty about the real economy and the macro momentum in the second half of the year. But more than that, it's just having some difficulty figuring out what a normalized pricing environment is. And that includes not just your more discretionary-oriented companies, but even some of your staples. What is a more normalized pricing environment?